Hello friends, I'm Abhijit Sengupta and I'm teaching in Accounting Academy in Nagpur since last 12 years. And today we will be discussing a very interesting topic of cost and management accounting called as standard costing, focusing mainly about the CS executive students. Okay, so in today's lecture, we will be concentrating on the basic concepts behind standard costing. The main intention is to understand the concepts behind it, then gradually we can understand the examples of it. So, should we start? Let's go then. Friends, we are doing accounting for a business. And why do we do business? We do business, of course, to earn profit. That's our main intention, of course. Now, since childhood, we know that how to calculate a profit. Profit is calculated by comparing the sales with the cost. Profit is simply sales minus cost. So what do you feel? If I'm doing a business, will I be moving on haphazardly? Will I be making my sales haphazardly? Will I be incurring the cost haphazardly? Whatever profit I earn, it's okay for me. Will it be like that? No, of course not. We will be planning, right? So if we plan, of course, planning stage in accounting, in cost accounting language, we might be preparing some budget. So once we are ready with the budget, we have the budgeted sales available with us. We have the budgeted cost available with us, and of course, now we know what is our budgeted profit. So we are budgeted, right? But gradually, as the time goes on, we will come to know about the actuals. Just like a student always makes a plan that I'm going to plan, say, about 10 hours a day. I'm going to study for around 10 hours a day, right? So if the student is thinking that he is studying for 10 hours, he has planned that he will be studying for 10 hours, and later on he comes to know that he studied only for 8 hours, or say 8 hours is too much, I will say maybe 4 hours. He has studied only for 4 hours. So he will come to know about the variance of 6 hours. We planned for 10 hours, we actually studied for 4 hours. This means that there was a variance of 6 hours. The same thing, same logic if we apply here, we budgeted our sales cost and profit, but now when we see the actual, so we will be able to compare the budgeted data with the actual data. And once we compare these two, we will be able to calculate the variance. So we will be able to calculate the variance of the budgeted profit and the actual profit. We will be able to compare the variance. We will be able to calculate the variance of the budgeted sales and the actual sales. We will be able to calculate the variance of the budgeted cost and the actual cost, the deviation. To calculate this variation and the study of this variance is what is called as variance analysis, or also known as standard costing. So I hope I have made myself very clear what standard costing exactly is. Standard costing, also known as variance analysis, is the study of variance. What kind of variance? The variance of sales, the variance of cost, the variance of profit. It can be some other things also. Now, once we are through with what variance analysis, what standard costing is all about, now just think about it. A variance can be in our favor, variance can be against us, right? So we divide this variance into two parts, a favorable variance and an adverse variance. Now, first let's discuss how to understand whether the variance is favorable or adverse. Let's go. So suppose, to explain this particular favorable and adverse, I will give the example. I will take an example of a seesaw. So right now you can see that, imagine that this is a seesaw. So as you can see that the seesaw is balanced right now, and it will of course bend to the heavier side. So now, if I put these two data here, what two? Budgeted profit and the actual profit. And suppose on comparison of these two, this is the result. What do you mean by this? My actual profit is more and my budgeted profit is less. So think about it. If I planned some profit, I wanted to earn some profit, and what I have actually earned is more than that. So is this good or bad? Definitely it is good. So if we earn a higher profit, this variance will be called as a favorable variance, right? But in the reverse case, if this is the case, what is happening now? Now the budgeted profit is more and my actual profit is less. I planned for a higher profit, but I actually earned very less. If I'm actually earning very less, then will I call this variance as favorable? No, this variance will be adverse for me, right? Same will be the case with sales. Sales is also an income. So if I have budgeted some sales and I can see the actual sales now, if my actual sales are more than the budgeted sales, I will call that variance as a favorable variance. While if my actual sales are less than the budgeted sales, I will call such variance as an adverse variance. Right? I hope I have made myself very clear about profit and sales variance. But as I said that I am focusing on the syllabus of CS Executive. If you refer your module, if you go through your module, then sales and profit variances are not covered in the syllabus. So what is covered in your syllabus is only a part of it, that is the cost variance. So let's come back to the seesaw then. Okay. Now if I compare the budgeted cost with the actual cost, budgeted cost with the actual cost. Now on comparison of these two, suppose this is the result. What is the result? What do you see here? That the budgeted cost is higher and my actual cost is lower. I budgeted a cost that was higher and my actual cost was less. Just think about it. Just take an example. Suppose you are going on shopping and you budgeted that you will be spending around say rupees 20,000, but you actually spent only rupees 15,000. Well, frankly, that's quite difficult for girls, I will say. But imagine, just imagine for the sake. Now, suppose 20,000 was budgeted and you spent just rupees 15,000. It is good or bad? It is definitely good. You saved rupees 5,000. So, if my actual cost is less than the budgeted cost, this variance will be in my favor. I will call it as a favorable variance. Right? While if the reverse case, which is a normal case in case of shopping, the example that I gave, if I budgeted to spend only 20,000, but when we went to shopping and I saw suppose all the girls were going for shopping and they liked some handbags, some shoes, some sandals, and etc., and they actually spent say rupees 30,000. Means your actual expenditure was higher. If your actual expenditure is higher, this variance is called as an adverse variance. Right? Is this okay? I hope the concept is clear about when we will call that the variance is favorable and when the variance will be called as adverse. Fine? Now, as I just said that CS Executive, the focus is in cost variance. So talking about the cost variance, all of you understand now that cost, if we talk about cost and we classify the cost on the basis of elements, then element wise your cost can be classified into three categories. What are these three categories? Material cost variance, material cost, labor cost and overhead cost. So we will divide the variance into these three categories. We will study about material cost variance first, then labor cost variance, and finally we will study the overhead cost variance, where again overhead cost variance will be subdivided into two categories: variable overhead cost variance and fixed overhead cost variance. Right? So should we start with the first part then? We are starting now with the first part, that is the material cost variances. Okay? When it comes to material cost variance, many of us think that it is just formula based. Just apply a formula and you will come to know about it, you will calculate the answer. Well, I will agree to some extent. It is a bit formula based, but it's also logical. If you don't apply the logic, then it will be quite difficult for you. So let's understand what essential things are needed to calculate a material cost variance first. So let's understand the essential requirements for material cost variances. Well, to calculate all material cost variances, we need 4 details. We need to concentrate on 4 calculations first. What are these 4 calculations? First, we need something called as SQ, then SP, then AQ, and then AP. SQ stands for standard quantity, SP stands for standard price, AQ stands for actual quantity, and AP stands for actual price. One by one, we will see the details of this. What is it? First thing, SQ, standard quantity. This is the most important calculation. Other calculations are not a big deal. Standard quantity is the most important calculation. If you are able to calculate that, you are through with the question. No problem. What do you mean by standard quantity? Standard quantity means the standard input of the material needed to produce the actual output. It is the standard input, standard quantity of the input to produce my actual output. Let's try to understand with the help of an example. Say, if I want to manufacture a product called as biryani, my product, the output is biryani. So all of us know, it can be veg, it can be non-veg, as the case may be, but all of us know that to make biryani, we need at least one material called as rice, right? So if I want to manufacture the actual output called as biryani and I need rice to make this output, I am calculating this variance for rice and not for biryani. Standard quantity is the standard quantity of rice needed to produce the actual quantity of biryani. Say for example, we had planned, we run a restaurant, say suppose, and we had planned that, we budgeted actually, that around we will be manufacturing 100 plates of biryani a day. Suppose, 100 plates of biryani a day. Now, if I am making 100 plates of biryani, suppose I have budgeted that for 100 plates, I need say around 20 kgs rice, 20 kgs basmati rice. I need that. Now, I'm not that good in cooking, but just assume for the sake. 100 plates of biryani, we need say around 20 kgs of rice. Okay? This is what I budgeted. But actually later on, I came to know, when we saw what is happening when actual customers came to us, we actually manufactured 120 plates of biryani. 120 plates. So just think about it. Will 20 kgs of rice be my standard quantity? No. My standard quantity is not 20 kgs. 20 kgs is my budgeted quantity. Standard quantity is something different. Why it is different? Try to understand. First, let's understand how to calculate the standard quantity. Just understand what I said right now. For 100 plates, I needed 20 kgs. So if for 100 plates we needed 20 kgs, for 120 plates, how many kgs will be needed? 24 kgs. So to manufacture 120 plates, my actual output, 120 plates, how much quantity should have been consumed? That is called as standard quantity. I'm again repeating, my budget was for 100 plates, I needed 20 kgs. But now, if I have actually made 120 plates of biryani, so I will be needing for 120 plates 24 kgs of rice. This 24 kgs will be called as the standard quantity. Now, why do you do like this? Sir, you just said that we will be comparing the budgeted data with the actual data. Now you are saying that we will be calculating the standard data, and you are also saying that the budgeted data and standard data is different. Why? The basic logic behind this is a principle of accounting called as matching. Just try to understand. I'm comparing budgeted data with the actual data. My actual data is for 120 plates of biryani. My actual rice consumption will be for 120 plates of biryani. So if I compare this actual data with the budgeted data, which was prepared for just 100 plates of biryani, will these two match? No. So accounting principle of matching simply says one thing, that whenever you compare two things, these two things should be matching. These two things should be comparable. So if my actual data is for 120 plates of biryani, my data, the budgeted data, should also be converted in terms of 120 plates. So when I convert the budgeted data in terms of the actual to make it matching, I call that data as the standard data. I hope this is clear. Why we are calculating the standard quantity instead of budgeted quantity? I hope I have made myself very clear. Okay. So now we have calculated the standard quantity. What else? We need the SP. SP stands for standard price. How to calculate the standard price? Standard price is simply the budgeted price. We must have prepared the budget. Whatever price we had calculated, we had taken into consideration while preparing the budget, that price is called as the standard price. And this usually will be provided in the question. It will be given in the question. No problem with that. Max, if they want to confuse you, so they may give a detail like this, that we budgeted to purchase, say, 1,000 units, not purchase, I will say consume. We plan to consume, say, 1,000 units costing rupees 10,000. 1,000 units costing rupees 10,000. So 10,000 divided by 1,000, per unit price will be 10 rupees. So they may try to confuse you like that. Standard price. Next data is the actual quantity. Actual quantity means the actual raw material consumed. Actual quantity means the actual input, the actual raw material consumed to manufacture the output. Now obviously this also will be provided to you. And the final data is called as the actual price. Actual price, of course, again it will be provided to you. So once we are through with these four formulas, these four calculations, now we can move ahead, we can proceed ahead to the calculation of the cost variances. These four calculations are made. Now one by one, we will be calculating the variances. What are these variances? One by one. So variances, if we look on the variances, so first variance that we calculate is called as material cost variance. Material cost variance, which is further subdivided into two categories, price variance and quantity variance, which is further subdivided into two categories, sub-usage variance, or also called as the yield variance, and mix variance. Now what is this? All of you understand that if I want to calculate the material cost, it is the quantity of material multiplied by the price of the material. Quantity multiplied by price. So first I will calculate the variance in the cost. But what are the reasons for the variance? It can be either variance in the price or variance in the quantity. So it is further divided into these two categories. Price, the variance due to price, the variance due to quantity. Once we are through with this, quantity variance is further subdivided into these two categories. To try to understand, when will we calculate these two? Suppose I am manufacturing a product for which only one raw material is needed. Only one raw material. If only one raw material is there, I will calculate my cost variance, I will calculate my price variance, I will calculate my quantity variance, that's it. It will end here. But if I am manufacturing a finished product for which I need more than one kind of raw material. Just imagine that we are making mixed veg. If we are making mixed veg, then my output is that vegetable, mixed veg. But for that, I need a varieties of raw materials, right? I need more than one particular raw material. So wherever I need more than one particular raw material, in such places, there can be a variance due to the mix, the combination of these materials. So in such cases, we further calculate, we further go into the depth of, we further analyze the quantity variance, which is further subdivided into these two categories, sub-usage variance and mix variance. Okay? Now, as all of you know that now CS Executive Cost Accounting paper is multiple choice question based. So they may ask you a multiple choice question. Multiple choice question, what kind of varieties can be asked? First variety. They may ask you a question on the concept of it. A theory question focusing on the concept of standard costing. What standard costing exactly is. We have already dealt with that. Second part, they can ask you any of the formulas. What is cost variance? What is price variance? What is quantity variance? What is sub-usage variance? What is mix variance? Any of the formulas. Now, there can be a straight question asking a question on the formulas or a back calculation. You may have to make a back calculation. What do you mean by a back calculation? Example. And just we'll be coming to it, but just a reference for the sake of reference. If suppose we are calculating price variance. If suppose we are calculating price variance, I will be telling you the formulas. Cost variance is standard quantity into standard price minus actual quantity into actual price. Price variance is standard price minus actual price into actual quantity. Standard price minus actual price, the variance between price multiplied by actual quantity. So why multiplied by actual quantity? We'll come to that. We'll see that. But price variance is standard price minus actual price multiplied by actual quantity. So what they may do, they may give you the standard price, they may give you the actual price, they may give you the actual quantity, and they may ask you to calculate a price variance. And it's also possible that they may give you the price variance. They may give you, say, the actual quantity. They may say give you the actual price also, and they will ask you the standard price. Mathematics, simple mathematics. So we have to calculate it, the missing figure, that can be asked. Or they can also ask you a question on reconciliation. Now what do you mean by that? Reconciliation means what? Just try to understand. Mix variance plus sub-usage variance is quantity variance. Further, quantity variance plus price variance is cost variance. So what they can do is they may give you the quantity variance, they may give you the price variance, they may ask you the cost variance. What do you have to do? You have to add this up, right? Or they may give you the cost variance, they may give you the price variance. You have to calculate the quantity variance, right? Or they may give you the quantity variance, they may give you the mix variance. You have to calculate the sub-usage variance. Or they may give you mix variance, they may give you sub-usage variance, they may give you price variance, and they will ask us to calculate the cost variance. It's possible, right? So this is another variety of question that can be asked, a question on reconciliation. Okay? So these are all the varieties that we are going to cover. Now let's see how the variances are actually calculated. So let's go one by one. First we calculate the material cost variance. Material cost variance is standard cost minus actual cost. Standard cost minus actual cost. So how to calculate the standard cost? It's the standard quantity, we have just calculated that. Standard quantity multiplied by standard price minus actual quantity into actual price. This is the actual cost, this is the standard cost. This is how we will calculate the cost variance. Now, as we have discussed right now, it will be divided into two parts, price variance and quantity variance. So if I want to calculate the material price variance, in short I have written it as MPV, material price variance. It is the variance of price So when it comes to variance of price, what I'm comparing? Standard price with the actual price. Standard price with the actual price. So it is standard price minus actual price, but it will give us only the variance of price. So it is to be multiplied by the actual quantity. See, I'll tell you how to remember the formula. It's quite simple. If I remember this formula, standard quantity into standard price minus actual quantity into actual price, very simple. Standard price minus actual price multiplied by actual quantity. This is price variance. And if I go for quantity variance, what it will be? Standard quantity minus actual quantity multiplied by standard price. Okay? Now logically speaking, how to understand that? Just think about it. You just went to purchase anything, say you went for purchasing some vegetables, say, or fruits maybe. Now when you went, you thought, or say your mother said that you will get so and so fruit or so and so vegetable at the rate ₹50 per kg, right? You went, and when you actually went to the shop, you found that it is costing around say ₹60 per kg. So there is a price variance of 10 rupees, right? You thought that the price will be 50, but actually the price was 60. So the variance was of 10 rupees adverse. You have to spend more. So now you actually spent more 10 rupees on how much quantity? The quantity that you planned or the quantity that you have actually purchased? Obviously, you're spending this money on the actual quantity purchased. That's why what you're doing, standard price minus actual price, the variance is getting multiplied to the actual quantity. This will actually tell me how much more did I spend because of this excess price. I hope I have made myself very clear. So this is how we calculate the price variance. This is how we calculate the quantity variance. Now quantity variance sub-analysis, that will be discussing in the next lecture. Sub-analysis of quantity variance gives us two types of variance. First variance is called as the sub-usage variance, which is calculated as standard quantity minus something called as standard mix, or we may also call it as revised standard quantity. Standard quantity minus standard mix multiplied by standard price. It is sub-analysis of the quantity variance only. So what will change is only something inside the bracket. Outside the bracket it will remain same, standard price, right? And what is mix variance? Mix variance will be standard mix minus actual quantity multiplied by the standard price. Now I'll just tell you in brief about this. What is standard mix? What we did here, we compared the standard quantity with the actual quantity. Standard quantity with the actual quantity. This is what we did in quantity variance. Now when it comes to sub-usage and mix, as I already told you, that these two variances are only calculated when we have varieties of raw material, right? Now when we have varieties of raw material, say to manufacture product X, we need raw material A and raw material B. So there will always be a standard ratio. Say if I need 100 units of in total input, then 60% of the input may be of raw material A and 40% of the input may be of raw material B. Possible, right? But my actual consumption may be in some different ratio, right? So what do you mean by the standard mix? Standard mix is the actual total quantity consumed revised in the ratio of standard. The actual total input consumed revised in the ratio of standard. If that input, actual input, would have been consumed in the ratio of standard, what it would have been? That is called as a standard mix or the revised standard quantity. Now understand this thing. Standard quantity and actual quantity. Standard quantity and actual quantity. The difference between these two was quantity variance. And now I calculated between these two something called as standard mix, right? Standard quantity minus actual quantity is quantity variance. Now I have calculated in between these two standard mix. So now to reach at this answer, I have two ways, right? One is this way, the difference, the variance between standard quantity and the standard mix. This variance is called as the sub-usage variance. Standard quantity minus standard mix multiplied by standard price. And further, if we compare the standard mix with the actual quantity, this is my mix variance. The standard mix that we have calculated compared to the actual quantity, this variance will give me the mix variance. So the combination of these two, sub-usage variance and mix variance, will give me the quantity variance. Clear? Understood this thing? So these were all the formulas of standard costing. What we have discussed today in today's lecture, we discussed the concept of standard costing, right? After understanding the concept of standard costing, I told you about the syllabus. We will study it into three parts. We will divide it into three parts: material cost variance, labor cost variance, and overhead cost variance. So right now we concentrated only on the formulae and the logic part of the material cost variance. We understood what are the various calculations to be made in material cost variance. We will continue with examples of how to calculate these variances in the next lecture. So thank you very much.